What if the next big Canadian stock isn't one of the big five banks, but a smaller, fast-growing company already listed on the Toronto Stock Exchange? Today, I'm breaking down 5 emerging TSX stocks, including their current share prices. Are you wondering which companies pay dividends? One even pays monthly, not quarterly, and investors are watching them closely for 2026. Stay until the end. Let's get into it. First up is Firan Plus. This is not your typical flashy tech company, and it quietly plays a critical role in global supply chains. Share price around 29.30 per share. Dividend, but there's a high prospect for growth. Firan produces high-purity specialty metals and then chemical compounds, and they are used in semiconductors, renewable energy systems, aerospace, and industrial applications. Why does that matter? Because advanced materials are essential to AI infrastructure, solar panels, and defense technology. This company sits upstream in industries that are growing rapidly. Now here's the key: it doesn't pay a dividend. That tells you management is focused on reinvesting profits into expansion and growth. This is more of a growth and industrial tech hybrid play. Risk, it's exposed to global demand cycles. Opportunity, long-term materials demand tied to tech and clean energy. Next is Firan Technology Group. Share price around 19.20 per share. No dividend as it's focused on growth. Firan Technology designs and manufactures aerospace and defense electronic components, including AAX and circuit boards. Now, aerospace is interesting right now. Global air travel demand is rebounding, defense spending is increasing. Aircraft production is ramping up. FTG is not Boeing, it's not Airbus, it's the company supplying critical components behind the scenes. And smaller aerospace suppliers can grow faster when the industry expands. If you're looking for a small to mid-cap Canadian aerospace play on the TSX, this is one worth researching. Now let's talk digital healthcare. Well hits. Share price around 50 per share. Cheap, right? No dividend. Well operates health clinics and provides digital health technology services. Well has grown through acquisitions and expanded internationally. Healthcare is defensive, technology is scalable. Combine those two and you get a company positioned in a growing niche: digital transformation of healthcare. Now here's the catch. This is still an emerging name. It's smaller, it's more volatile, and profitability metrics are closely watched by investors. But if digital health continues expanding, companies like Well could benefit significantly. This is a higher risk, higher growth profile stock. Now let's switch sectors completely. Dividend 118 to air. No dividend. Aritzia is one of Canada's strongest retail growth brands. It has expanded aggressively into the US and built a loyal customer base. Retail is competitive, but premium brands with strong identity can scale internationally. What makes Aritzia interesting is strong positioning, growing US footprint, revenue expansion potential. Unlike many TSX stocks, it does not pay a dividend. It reinvests in store expansion and growth. This is a consumer growth play, not an income stock. And consumer stocks can be cyclical, so earnings results matter a lot here. Before we head over to the final stock that pays dividends, please subscribe to our channel and share this page with your friends and family. Now here's the one income investors may like: Extendicare. Its share price 24.25 CAD. It pays dividend monthly at a 1.96% rate. Extendicare provides long-term care and home health services in Canada. That makes it attractive for investors who prefer steady cash flow instead of waiting for quarterly payments. Well, why is this sector interesting? Demographics. Canada's population is aging. Demand for senior care services continues to grow. So Extendicare gives you exposure to healthcare services, income generation, demographic tailwinds. It's not a hyper-growth stock, and it blends income with moderate growth potential. Quick recap. Firan Plus in materials and tech supply chain, no dividend. Firan Technology in aerospace and defense, also no dividend. Well Health in digital healthcare pays no dividend. Aritzia in consumer growth also pays no dividend. Extendicare, senior care monthly dividend payer. 4 growth-focused reinvestment stocks, 1 monthly income stock. Emerging TSX stocks can offer higher upside, but they also come with higher volatility compared to Canada's megacaps like banks or railways. Always consider earnings consistency, debt levels, sector risks, and your personal risk tolerance. And of course, this is not financial advice. Always do your own research. Now I want to hear from you. If you had to pick just one of these 5 stocks to hold for the next 3 years, which one would it be? Drop it in the comments. And if you want more Canadian stock breakdowns, especially emerging TSX names with real growth potential, make sure you subscribe and turn on notifications, because next week I might cover 5 Canadian dividend stocks that pay you just to hold them. Don't forget to subscribe. Thank you for watching. See you in the next one. Jesus loves you.